Hey, Sae'Von, how are you?
I am blessed, Sammy. How about yourself?
I'm doing well, and I'm really excited for this conversation. Polled our audience, and they actually really want to learn about the technology behind crypto and blockchain. So, had to find an expert because I myself don't know as much as I'd like to. So, for those who don't know you and know your journey, tell us a little bit about yourself.
Okay, excellent. So once again, thank you for having me on, and I'm excited to be able to help your audience in whatever way that I can. But the long story short, I'm from Atlanta. Growing up, I'm super focused on academics, sports. So I did that, played ball, and I worked. So did that. I worked for a company called Cutco for a few years, and I was based out of Atlanta there. Ran a branch office in South Carolina for a summer during the summer in between my freshman and my sophomore year at UGA. Graduated from there with a degree in psychology and a minor in Spanish. And while I was at UGA, I spent a lot of time in my junior year learning about money, just the history of fiat currencies and what has served as money over time. And in 2017, I was encouraged by a friend of mine to look a little bit more deeply into the crypto and blockchain market. So that's when I first put some bread in the game, bought some Litecoin, but I got in at the very end, so it was Q4. So I still rode a little bit of the wave before I knew it. I'm snapping my neck like, what's going on? This market's collapsing. And so from what I knew from regular investing, just traditional financial wisdom is, okay, you really only lose if you sell. So I was like, all right, we're down. Let's just hold out, wait till the next cycle. And in between that point, I really just 2018, I wasn't too deep into it, but toward the end of 2018, really going to 2019, I spent a lot more time just studying every single day the market from a more fundamental level, the tech of it. I also started dabbling in Forex and just TA and that sort of thing. And then before I knew it, I'm spending 2-3 hours every day just head down studying this as best I can. And I really just started every single ever saving 20% of everything that touches my hand. And about 90% of that I was putting into crypto and blockchain in anticipation of what we were seeing this year. So yeah, man, then time comes last year, I'm sitting down one night and this voice says in my head, teach them how to fish. And I'm like, what is that supposed to mean? So I sat on it for a little while and realized there are so many people who could benefit drastically by really having a deeper comprehensive knowledge of how these technologies work and more than just the price go up, price go down side of it. And so that's when I really put my head down, and many months I just put together everything that I knew in as best of a package as I possibly could so that there'd be a platform for people to really plug in and learn about blockchain and digital assets. So that's a little bit of the journey.
Yeah, man, that's awesome because you touched on a point where fundamental and technical analysis of things like cryptocurrencies totally different than regular stock investing. It's
Yeah.
a there's not as obviously a P&L, it's not like a product company and stuff like that that you could just track and know earnings reports and stuff like that. It's more project based and different types of things. What are they looking for and what does the future hold for those types of cryptocurrency? Talk to us a little bit about what is a blockchain powered platform, and then how does that differ from something like Ethereum, where it's a cryptocurrency that a lot of other cryptos are built off of?
Okay, phenomenal question. So I think one of the important distinctions out the gate is to know that really in as simple as terms as possible, a blockchain is immutable verifiability. And so what that basically means is the same way that if somebody on their Windows computer or their Mac, they have a file, they can change who has permissions to edit that file. And when you have a blockchain, it basically means that nobody has permission to edit that file, or if somebody does, everybody can see it, not just the company or the platform that's using it. So for right now, if we wanted to see exactly all the trades that have been made in Goldman Sachs ledger, we aren't able to do that. But when you use something like Bitcoin or Ethereum, all of the transactions that have ever taken place, you can see, and they're all being verified in real time, depending on their consensus mechanism. So when there's a blockchain powered platform, and I'll take something, for instance, like Nexo, it's a lending and borrowing platform. What it means is that all of the lending and borrowing that they're doing, it's all verifiable. So you can look at the ledger and you can verify where the debits and the credits are happening. And it's based on what's known as triple entry accounting, so that everybody at all parts in time, chronologically, there's an order of exactly when those credits and debits took place, to whom they took place between, and the time of them. And nobody can go in and alter that record after it's been made.
So that triple ledger technology, is that a synonym for decentralized or distributed ledger or DLT?
So it's you can look at them in a similar manner, and not all blockchains use it for that reason, but one could, as a heuristic, look at it in that way because there aren't many things that allow for triple entry accounting unless you're using a blockchain to do. And that's a fundamental base layer of how the blockchain works. And then when you build other things on top of it, it can give it added value because it removes the need to trust that what that database is telling you is accurate. And that's really where we see a lot more applications being built on blockchain platforms because for the user, it makes them more likely to put their money on something if they know there's no way for this to be spoofed. There's no way for this to be incorrect or disingenuous.
So a couple questions there that just sparked my mind is you had mentioned that it's a technical technology and it's a security way of transacting between things. Like you called it immutable, right? And verifiable. So when things get hacked or when things get, I think Ethereum had an issue with that recently and a couple months ago and stuff like that. People need something like a wallet and a cold storage on top of that in order to provide a further level of security. So if the cryptocurrency itself or if the blockchain technology itself is supposed to be completely secure, why is there additional levels of measures needed? And I think that's where some of the skepticism may come from.
Once again, great question. So as you said, there's layers to it, right? And so at a fundamental layer, the blockchain themselves, that's where that verifiability comes in. But when you have something like Ethereum, which is a smart contract platform, an easy way to think about it is something like JavaScript or Python. It's a language that you can then use to build other things that interact with the underlying Ethereum network. And so when we hear about hacks, what's usually happening is that protocol that decided to build something on top of Ethereum, that protocol was hacked because the way in which they designed their smart contract left vulnerabilities for exploitation. It's almost never the fact that Ethereum or even Bitcoin actually got hacked. It's a protocol that was built on top of Ethereum that had holes in its code. And for instance, there was, I can't remember the name of the platform right this moment, but there was a hack of several $100 million on one of these DeFi aggregator platforms, right? Where people can put their money in there, stake something, and then pull it out. And what happened is for that to work, you basically have a bunch of different pieces of code. And some people think of them as like a digital vending machine that says, okay, when this happens, then do this. And what they're using is the information that is coming from the Ethereum blockchain. That information is verifiable and accurate. And then they're plugging it in as triggers into their protocol that says, okay, if the Ethereum blockchain says this number reaches 10, then do this next action, pay out 10% of whatever money is in this fund. And they use something called oracles to pull that information back and forth. But basically, if somebody has an error in that code and somebody goes in looking through the smart contract, because all of these things are open source, and then they find that code, they can figure out a way to exploit the error in the logic of how they designed that particular smart contract. But it's not Ethereum that's being exploited, it's that contract that's being exploited, if that makes sense.
Yeah, so just try to rephrase to make sure I understand it, is that they're trying to figure out what the output of the blockchain would be so that they can hack into that smart contracts code and understand what the intended result is in the if statement, if you will.
That's a pretty good way of looking at it. They're saying, okay, where did they get sloppy in building this code on top of Ethereum? How can we then exploit that sloppiness in their code? And that's usually why it's the smaller, lesser known platforms that are vulnerable to hack, because another way to think about smart contracts is like APIs. Literally, they're the exact same thing. So people start to take these different pieces of these different protocols and then they smash them together. But maybe there's an unintended consequence with how they design that integration of the APIs so somebody can see that's where they attack.
Yeah, and that brings up a great question from one of our listeners, Patrick. And guys, remember, if you ever have any questions that you'd like me or a guest to answer, either Instagram, DM me at FinanceZilla or send me an email at financezilla@gmail.com. But Patrick is asking about what are your thoughts on the scalability problems that some networks like Ethereum are running into? For example, like the crypto kitties and other events that happened. And what are the best resolutions while maintaining the decentralization? Is Ethereum to the right direction to do that?
So They call this problem like the trilemma. You basically have decentralization, scalability, and then you have the cost of it. The price is one of the things, or rather the privacy nature of it. And something like Ethereum, it's definitely the leader right now. And in my opinion, the short answer to that question is it's still figuring it out. And part of what I think people should keep in mind is, as we just spoke about, it's often the smart contracts that are built on top of these blockchains that are being exploited or having issues rather than the network itself. And in Ethereum's case, it's funny because the reason for the scalability issues is because of how many people are using it.
Yeah.
And at this point in time, it strikes the best balance, in my opinion, of actually being decentralized, but also having sufficient throughput. And if you compare that to something like Solana, Solana is way faster, it's way cheaper to use, but it is very centralized in comparison to something like Ethereum. And even a few weeks ago, the actual network went offline for over 8 hours. The actual network crashed. Ethereum has not had an issue like that, I don't think, even since inception. It's never crashed like that. Now, granted, that's where you start to see where people are making these trade-offs. And part of why that is when you have more people running something, so the more decentralized it is, it makes it so that if one, let's call it validator, one person who's hosting the network, if their system goes down, there's a bunch of redundancies of other people running that network. And so we can pivot what nodes, the information, what they're running through. And that's part of the transition for Ethereum, moving from Ethereum as we know it right now to ETH 2.0 is a switch to the sharding system and the sharding approach. And granted, when they make that transition, maybe they do have an issue. Maybe they do go off because that approach would be more similar to something like a Solana. But it's one of those things where we're watching the technology evolve in real time. And so if somebody wanted to diversify, what I would say is don't be a maximalist about anything. Look at what application you're trying to use and ask yourself, is there a better network where I can use this? So for instance, DEXs comes to mind, right? So decentralized exchanges. If you were to use a decentralized exchange on Ethereum, you're going to be paying a lot in fees. So to make a trade, I was even looking at making small trades this morning. The fee was going to be $72. If I wanted to make that exact same trade on something like Matic or something like Solana or even Luna, that trade might be a few cents. It might be a fraction of a cent. But that goes back to, okay, how centralized is that actual network? Are there 10 validators versus 10,000 validators for Ethereum? And not all applications need to really be as decentralized as some of the other ones. So I'm not an engineer, so I'm not going to pretend like I can espouse the solution. They're still working it out, but I have confidence that the way that Ethereum approaches their solutions, it's going to be a favorable outcome. And part of that is because of how many developers they have. Almost, if you were to throw out 100 projects in the blockchain or digital asset world, odds are the vast majority of those are running on top of Ethereum. And even when you look at something like Visa or MasterCard choosing what network they want to use for their payments, still choosing Ethereum, even with the fees. So to me, from a fundamental level, is I look at things like that. Okay, they have the budget, they have the resources to investigate and research these things. And if they're still comfortable using Ethereum, I think we're still in a good position from that fundamental technology standpoint. But the fees are ridiculous.
Yeah, I agree. I'm used to now investing and trading without fees in stocks, thanks to Robinhood a couple of years ago. And it's just now when you're trading crypto, it's like, oh man, I forgot that this used to be a thing for everybody. And it just puts things into perspective how far technology has come, and it keeps changing. And the fact that we can do everything online, and the fact that you could trade things either via Dex's platform, like we were talking about, or I personally use Coinbase Pro, which has cheaper fees than Coinbase, but it's a couple percent, it feels like, when you're making a bigger trade. So it hurts.
Oh, for sure.
So when somebody comes to you and says, I hear what you're saying, but it's above me, I don't understand it as much. So it's considered a speculative investment. And crypto went through that in 2017, 18. And now I feel like this year, a lot more people are seeing its quote unquote truth because of the fact that it's run up a lot and it's getting a lot more publicity. And if you look back or you look forward a few years, is NFTs going to be the same sort of thing where right now it seems like it's purely speculative? Not a lot of people know what it is, and therefore they just say this is something that's like a joke and some people can make money off of it, but it's not real investment. versus a couple years down the line, we'll be saying the same thing?
So I think the best analogy for something like NFTs, it depends. The other thing about NFTs is they're not all the same. And I think the question you just asked, most people think of NFTs as the pieces of art. And if we were to go down that tangent for a second, then we must understand that there are different asset classes, right? And most of retail, one, are not in the position from a financial standpoint, but two, don't have the expertise to really be a successful investor in alternative assets. And think about who are the sort of people who invest in lumber, who are the sort of like buying forests, who are the sort of
Right.
people who invest in art. They have millions and millions of dollars and they're looking to diversify. And for that sort of reason, even in crypto, most of the people who are really making money in NFTs, they are millionaires. And they are buying these NFTs as alternative investments to diversify within the digital asset arena. And so from that perspective of things, I think it'll still be around. And just there are still people who invest in art, but most people are not investing in art. The difference, though, is how equitable it can be to begin to mint an NFT and get into the space. And so what I think the true longevity of NFTs really is comes from the royalty mechanism. And I've been saying that all year long, because as it stands right now, if somebody puts out a digitally based piece of work, it's damn near impossible to track down anybody who has forged or made a derivation of that work and then recoup what you are owed based on that derivation. But with NFT, it is a built-in mechanism that will automatically track all future sales of that item and then pay you back that royalty in perpetuity to whatever royalty amount you set. And that will happen automatically directly to your wallet. So it's not like PayPal has to send the money to the bank and then the bank has to clear it on the back end and the Bank of International Settlements. And then once that clears, then it goes to your Wells Fargo. And then, so I think that's what most of retail doesn't understand, because most of the people looking at the space are not creators. And so if they were a creator, it's just like this podcast. Imagine every podcast you put out, somebody could own it if they wanted to. You set a price for it. And then if somebody wanted someone else to listen to it, maybe they sold it to them for you 5 cents or something, but you got a percentage of that 5-cent sale. And every time somebody listened, it came back to you. So I just think the whole idea of royalties is really powerful. And we've yet to see the music industry really step into this game, because the whole issue of master ownership, and I'm a musician myself as well, I produce, I rap, and that whole side of things, I think, is where we're going to see some tremendous traction with NFTs once artists or groups like Warner Music or Universal start to release their catalogs as NFTs, so that anytime anybody resells that audio in the future, or anytime somebody even streams it, there's an automatic royalty kick out. I think that's when we really start to see the utility of NFTs. But I definitely would agree that right now we are seeing the 2017 ICO mania. We are seeing that with NFTs. I'm not confident that the next bull run will see such a tremendous markup in NFTs, but I do think they'll still be around, and we'll see what kind of cements itself the way that Bitcoin has, the way that Ethereum has. But in that next bull run, there'll be a new derivation or a new spin on how to use NFTs and get the value out of it. It won't just be a picture or a JPEG that's going for $2.7 million. I think that'll still happen in private, but most people won't be using it that way.
No, and I really like that idea, because everything is always, when it first comes out, there's a few edge cases that just blow up, and that's what gets all the attention on it. But it's the fact that what is the actual use of it? Okay, yeah, that it's a minted thing that nobody else can have the actual picture of. And they use the Mona Lisa painting as an example. There's many replicas, but nothing holds the amount of value that the original does. And true, but it's not necessarily a collector's item. It's more of something that it's a diversification of an asset class. I like the way you worded that. Shouldn't be your only strategy. It should be something that if you have extra discretionary income that is you want to swing for the fences and hit on, then do that. But I wouldn't make that your only strategy, just like I wouldn't make even crypto my major strategy. It's a holding of a portfolio. It's not the holding.
Yeah, no, very well said.
You had mentioned in your response, though, about wallets and cold storage, and I don't know enough about it. And so I guess I would just pose for the first question is, give me the difference of what a cold storage wallet is versus a regular wallet, and how does that differ from me who has my money in Coinbase Pro?
So basically, there's only two types. You have custodial and non-custodial. Even the names are clean, but custodial means somebody else is holding it for you, and
Mhm.
non-custodial means you hold it yourself. And so in Coinbase Pro, Coinbase actually holds your funds right now. So same way
Mhm.
that people who have hundreds of millions of dollars, they don't keep that in their house. They keep
Right.
it with a custodian, whether it be Goldman Sachs, whether it be some other bank. Coinbase is holding your funds right now. If you have a cold storage wallet, you hold those funds. Now, it's your wallet that holds it, but obviously the wallet is your possession. You're the one holding those funds. So you're entirely responsible for the security of it. If you lose your wallet, if you misplace your keys, if anything like that takes place, that's on you. Whereas when you go with a custodial option like Coinbase Pro, you're effectively putting that burden of security onto them to say,
Mhm.
okay, I trust y'all's process. I trust your back end security to keep my funds safe. And I think it's easier to just let you do it from a convenience standpoint and a peace of mind standpoint versus the risk that I then incur by holding it myself. And the difference there simply comes down to a question, once again, of trust. And as I said before, I don't think there's any need for extremism, but the fact of the matter is thus, unless you hold the private keys, you don't own those assets. It's no different than a bank. And we know
Mhm.
how fractional reserve lending works. That's not your money. It's when you put it in the bank, you literally gave it to the bank. It is the
Mhm.
bank's money. When you want to withdraw it, they give you what you asked for back. And it's very rare that they will not give you what you've asked for. Those are,
Mhm.
once again, edge cases where a bank's like, no, super edge case. So similarly, it's very unlikely that you would ever go to Coinbase Pro, try to withdraw your funds, and then there'll be some error where Coinbase does not give you your money.
Right.
But for some people, they don't want that burden or that possibility at all. And I myself am in that boat. I don't ever want to be in a position where some other custodian can tell me that I can or can't access my funds. And it brings to mind a story that Ryan Leslie told recently at an Earn Your Leisure convention. And he actually told how he got into crypto. And it's because he had a few $1,000,000 in a traditional bank and he went to withdraw it and the bank froze his assets. If you have personal custody, self-custody through a cold storage solution, nobody can freeze your assets. You always can control them and do what you need to with them. Whereas when you trust a third party like Coinbase, even as legitimate as they are, technically, if they have their reasons and you read their terms of agreement, they can freeze your funds. They can
Right.
refuse your ability to withdraw. And second to that is the ability to actually activate your digital assets in more exotic ways within the space. So for instance, if somebody wanted to deploy their assets to a high yield earning protocol, you need to control the private keys. And you control the private keys in Coinbase Pro because you can withdraw them. Unlike Robinhood, and Robinhood's going to add this feature they've announced, but you would need to be able to control your funds, pull it out, and then deposit it into this other thing. But you need the private keys to do. And depending on how the wind is blowing, there's also been instances with Coinbase, and this is most centralized exchanges, when there's really high volume, the exchange always suddenly seems to go down for some reason.
Yeah, they had a rough day a couple months ago when it blew up, and then it was down like immediately, and it was not fun. Millions of
Yeah.
transactions
So
weren't executed.
exactly. And so that can be one of the benefits of keeping some of your funds, if you don't have to do all of it, in something like cold storage or even a hot wallet, which is similar, but it's connected to the internet. That's something like a MetaMask or something like a Trust wallet or even Coinbase wallet. And that would allow you to use a DEX because there's no way to shut a DEX down. So in high volume timeframes, even though you're going to get charged a fee, if you can't access your funds to get out of a position and you didn't have an order already set to trigger, if the system is down, it's not going to trigger that order. You can then use a DEX to make sure that you can actually execute your order. So there's many different benefits to having at least some of your funds in cold storage, and especially for people who want to get into the estate planning side of things, anything you're planning on holding long term should absolutely be in cold storage. No question about it, in my opinion.
Okay, that's good to know. I think it's also just the fact that can you interact with the DEX environment without a cold storage or a hot wallet? Do you have to have your own type of private keys in order to trade on that platform?
Yes, because of the nature of the smart contract platform. Now, granted, theoretically, based on APIs and whatnot, Coinbase Pro, they could integrate a feature down the road that allows you to pull directly from your Coinbase account
Mhm.
into something like a MetaMask, but they would just need to program that connectivity, because technically you do have the access to withdraw from Coinbase. They would just need to make a direct route. But the quicker solution for that would be you would simply transfer your funds out of Coinbase Pro to your Coinbase wallet, and then you can do the same thing. But most decentralized exchange protocols, the only way they will operate is by interacting directly with a self-custody solution, be it and in most cases, you actually need a hot storage wallet, which is something like a web-based wallet or even an app-based or a desktop wallet like Exodus or something like that. But most DEXs, almost all of them, as long as they're built on Ethereum, are compatible with MetaMask. And then depending on the network you're using, Solana, you need to use a different wallet like the Ghost wallet or something like that. But when you log on to these DEXs and you try to connect, they'll tell you which wallets they're compatible with.
Okay, that makes more sense. And obviously, we'll have some links on how to get there in terms of which wallet you need to in the show notes. So help a little bit there. When we talk about, you talked about staking a little bit earlier, and I wanted to circle back. Staking, essentially, if my understanding is correct, is where you're putting out your tokens or your coins and allowing to receive some sort of interest off of that. And there's something that's also like a high yield, high passive yield account in cryptocurrency. Question one would be, what is the difference between the two, if there is? And then question two would be, why would it be a good thing to have a volatile kind of investment like crypto where it can go up and down really quickly and use that as something that generates passive income?
So the first part of that question, for real, there's really is nomenclature between staking and the passive yield things. Now, typically when somebody mentions staking, it is, to your point, they are then going and using that to do something else with, but also it's typically done through a decentralized fashion. And usually the staking is done directly with the network that token is from. For instance, if you wanted to stake your DOT, you can do that directly through some protocols designed by the DOT team, the DOT developers, and do that directly with them. Project I'm invested in is called Grow DAO, and you can go on their platform and you can stake it. And sometimes when you stake a certain coin, you need to pair it with something that balances it out. So a lot of times you have to take, let's say 50% of something like Polkadot or Grow, and then you need to have 50% of some other token like USDC so that you can provide liquidity on both sides of that trade. And so that's technically liquidity provision, something like market making. But for most people, if you think of staking and passive interest, it's the same thing. You put your funds somewhere, it's going to earn some interest, you take it out. Sometimes there's a time limit on it and it locks it in there for a week or 30 days or 60 days, and they'll let you know if that's the case, and they will communicate it, and it's your choice. And then sometimes there's no lockup period. And the other difference I would say is depending on what route you go, if you use something that's a decentralized protocol, or if you do it directly with that protocol or that smart contract, you're usually going to have to pay Ethereum fees or that network fee to make that transaction happen, as it pulls it directly from your custody wallet. Whereas something like Gemini or even Kraken or even Next, based on how those are more centralized exchanges, they'll usually eat those smart contract costs for you to be able to earn interest. But something in the case of Nexo, literally by default of your assets being on that platform, they earn interest. You don't have to hit a stick button or do anything separately. On Nexo in particular, you can do that to earn slightly more. You can lock it up for a 30-day period or something like that if you choose. But literally, when you make the deposit to their platform, you automatically begin earning it. So to your question about why would somebody want to do it, the fact of the matter is you don't have to leave it in that volatile asset. The reason somebody may want to do that is if they are a long-term believer or they simply want to accrue more of that asset. So it would be equivalent of, let's say you're a really big Apple investor. You really believe in the strong fundamentals of Apple. They got some good financials, right? Apple's a strong company. I'm pretty sure they'll be here 50 years from now. And let's say there was a way that you could earn more shares of Apple by depositing your shares of Apple with somebody else. That's why, even though Apple goes up and down, if you have a long-term conviction or you simply want more Apple shares, that would be the justification in and of itself to do that, because what you're going to earn interest in is the shares of Apple itself, not fiat denominated interest. So that's where somebody might eat the volatility, because all the while they're just accumulating more of that asset that they want to hold, maybe for the next bull runner, because they think that when Apple gets into electric cars, it'll 10x or something. So they want to earn more of that now. The flip of that, and this is what a lot of people don't know, is that you don't have to be in a volatile asset to earn interest in crypto. You can convert your assets, and this is, if anybody didn't know this already, I'm giving y'all some sauce right now. Please take it. You can convert your assets to a stable coin, and you have many. There's different variations, and it's based on what they're backed by. You can convert it to a stable coin, deposit the stable coin, that's stable, and earn interest on it. And so if somebody, and this is the example I give to people because it's easy math, it's palpable. If somebody, let's say their net worth was 50 million, go ahead, park 1 million in stablecoin, right? If you're earning 10% annual interest, which is very easy to do, and it compounds daily, you will literally print $100,000 that year, not lifting a finger. Guaranteed. No risk of downside. It's a lot better than a lot of these bank accounts that are giving you 0.0125%. All the while they're taking your money, putting it in mutual funds, putting it in the stock market, and then they're actually generating yields of 5, 6, 7, 8% or higher sometimes, and they give you that little pence back at the end. That's something that's just never been possible. And even a platform like Nexo, because it's on the blockchain, you can literally go to their website and you can look real time at their asset allocation, and you can see how, because they're an over collateralized platform, and you can literally look at their funds under management in real time and see how it changes versus what they have loaned out. And because they're over collateralized platform, they literally will always be solvent, because if everybody that they loaned money to ran off, they keep all of their collateral, which is more than what they took out in the loan.
Interesting.
And most people don't know that.
Fair enough. Fair enough. So you mentioned a bunch of different smaller tokens and smaller projects that you've done research on, and maybe you've invested in, maybe you haven't. You don't really have to answer that part of it. But when somebody's trying to look at what the next DeFi token is and what has the most potential, what are some of the things that you would look for and do some of that fundamental analysis to figure out if that's something that's worth your time to invest in?
For sure. So one of the first things I would say is you want to look at the allocation. What are the tokenomics of the project? That's where you would look at what's the total circulating supply, what's the maximum circulating supply, what's the vesting schedule for any early investors and any allocations to their treasury, that sort of thing, because that's going to give you an idea of basically also you can figure out if this is an inflationary token, is it a deflationary token? And that's a good starting place to begin from the tokenomics side. After that, one of the easiest things you can do is look at who invested in it. So follow the smart money, right? Look at what, and some big investors or places like A16Z, Andreessen Horowitz, right? You can look at Three Arrows Capital. You can look at Naval Ravikant. He's an angel investor. Did he put money in the project? And there's a bunch of different investors. But if you see, for instance, like this trifecta, if you see Coinbase Ventures and you see A16Z and you Polychain or Three Arrows, it's a very strong chance that's a very strong project. And part of that is because these are more selective investors. And when they allocate, they're allocating by the usually tens of millions, if not hundreds of millions. And so all of this information is more or less available for somebody to find out. So look at those things, but also just look at the project. What's the user interface like? If you landed on this website, does it seem sketchy? Does it seem like somebody made it overnight? Or does it seem like a lot of money went into the design of it, the marketing of it? Is the language cohesive? Anything you would still do in the traditional financial world, vet the project itself. Do they have users? What is the adoption curve of their users? What's their total assets under management? What initiatives do they have? What is their roadmap? Have they completed their roadmap? Who are their development team? Who works for them? Are these people who used to work at Goldman Sachs? Did they used to work at Facebook? Did they used to work at Apple? And I go into this in a lot more detail in the course, and there's a lot of free information online that somebody can look at. But those are definitely some places I would start at for most people. So check the team, and the team includes the investors, the people who manage and run the protocol, as well as the developers. Check the tokenomics and the vesting schedule. The longer the vesting period, so basically the more time until the original investors can sell, the better, because it shows that they have a long-term orientation in the project. You don't want to see some sharp drop-off where a month after they release the token, all the investors can sell.
Exactly.
You know what I mean? So you don't want to exit scam like that, but there's a lot of different ways you can approach it, but I would definitely say those are some good starting places.
Yeah, and you mentioned your course, and I want to ask you a few more questions, but since you brought it up, I might as well talk about where is your course can be found, where can they connect with you and learn more about obviously your extreme knowledge that we can't cover in just 40 minutes here.
Yeah, no, thank you. So nativeassets.co, so no.com, .co, and you can find it there. So the course itself is called Blockchain Foundations. And the intention there was to take people who may know zero, literally zero, about digital assets, blockchain, cryptocurrencies, and put them to a position where they are within the top 1% of people on planet Earth in their knowledge and understanding and exposure to the sector. And we do that through an interdisciplinary approach by studying not just the cryptocurrency side of it, but the tokenomics. We talk about economics. We talk about the philosophical implications. We talk about the societal implications. And there's just a psychology of it. We go over trading, so technical analysis. We have hours of that within the program, but we also talk about how to do fundamental research. We talk about investment theses. We talk about how to actually do financial planning and estate planning for yourself down the road, just considerations you need to have. Simple things like about having a bounce back fund or a runaway fund, so that if all shit hit the fan, you have something to live off of for a certain amount of time. It was important to me that I provide that cohesive 360 of information, because in my opinion, the best way to be an investor is to really approach everything like investing, not like cryptocurrencies are special. Now, there are some differences for sure, and that's where Native Assets comes into play, because we specialize in blockchain and digital assets. But richest man in Babylon, right? Think and grow rich. There are fundamental principles to wealth that will never change. And that still is the case even in this digital asset era. And so we definitely spend time addressing that as well. That can be found at nativeassets.co/foundations, or you can just go to nativeassets.co. You'll find it there. There's links in my bio, all of that. And for people who aren't quite ready to jump into that, and it's an investment, it's not crazy, it's $297, so that there's no, oh, how much is it? But we also put a book out. And so the book it's a really good starting place for people who are a little bit on the fence and don't know if they're quite ready to start mastering the investing side, because that's what the course is really for. We give you all that information, but the idea is within 21 days or less, we can make sure that you're profitable should you follow certain steps. But the book is for people who still are a little bit on the fence, still a little bit skeptical, and want to learn about how it works and aren't as concerned about how they can profit and make money in the market. And that book is called Blockchain Blueprint, a practical guide to crypto in an impractical age of fiat. And they can get that through Amazon. They can get the paperback, and they can also get the ebook version. And if you enroll in Kindle Select, or if you're a new Kindle user, you can actually get the book for free through that program.
Yeah, that is extremely awesome that you'd be able to concisely put those things together in both a book and a course, because people learn in different ways and different mediums, and you can talk about it, you can draw it out, you can read about it on your own end, and eventually just doing it is the best learner, at least for me, because that's the type of learner I am. I just have to get in there and figure it out. But man, I learned a lot, so I appreciate this, Sae'Von. And I do want to ask if there's something that inspired you. I know we talked about the 2017 discussion that you had with a friend, but what kind of things related to discipline in this area did you have to learn? And where did you draw that inspiration from, or draw that skill set from?
So, like with traditional investing, emotions, managing your emotions. Because as I mentioned earlier, when I first came in, my money damn near tripled or more in a few days. And then I went away for a couple of weeks. I took a trip, came back, and then it's all plummeting. And at that point, I could have just panicked and sold everything, like in any market crash or market correction. But I didn't. And for that reason, it kept me invested mentally, intellectually, emotionally in the space. But even through that period, anytime somebody has conviction about anything, and it's not just investing, you have to manage the emotions. Because even as I was building this program, I thought it would take me about 2 months. It took me about 7. And the whole time I'm fighting if I should even make it, if I should even finish it. I'm like, what's the point? And I imagine you may have had similar feelings when you were building your course and making your books, where are people even going to want this? Are people even going to buy this? Are they even going to be helped by this? Who am I to even be talking about this? And all the while, you kind of have to pull the emotion out of it and go back to what was your thesis about doing it in the first place. People need to know this. Their lives will be better if they know that, oh, let me go forth and do it. And for me, it was really getting to the other side and starting to see people tap into it, starting to see how it changed their lives, where it was like, damn, I'm so glad I didn't give up, I didn't quit. And I hope that can just be a lesson for any endeavor somebody has, whether it be through investing, whether that be interpersonal, whether that be a relationship, whether that be something else they're working on in life. There's going to be lows, man. There's going to be some tremendous lows, and there's going to be some amazing highs. But do your best, as I try to do, to stay even keel the whole way through. Don't be swayed too much by either one. Be grateful, appreciate it, but know that it is just one moment of life, and you don't know what life will bring tomorrow. You don't know what life will bring 10 years from now. So enjoy the process, be present in the process, and be open-minded to what new changes and benefits could come down the road.
Man, I love that. That's definitely something that everybody I think can learn from and just continue to stay the course, if you will, and get 1% better every day, man. That's awesome. And I appreciate your time, Sae'Von, and I look forward to continuing to follow your journey, man.
Absolutely. I appreciate you. Thank you for having me on, Sammy.